What's up, guys? It's Amma Jamma here, and I'm here to go over one popular phrase in trading that we get a whole lot of questions about in our Discord in particular, and probably in many other Discords. And the phrase is double down. And what does it mean? What is double down? What does double down entail? And the do's and don'ts of doubling down. All right. Those are the three things we're going to address as far as double down in general. And a couple things about double down. In general, there is two different methods to scaling into trades. All right. There's the 25, 50, 25. Well, there's a few. There's the 25, 50, 25, 50, 25. There's 25, 25, 50. And then there's this is my particular trade. Now, keep in mind, this is me specifically, but there's another version of this. For me, it's 15, 30, 55. Or more commonly known as a 20%, 40%, and 20%, which is very close to the 25, 50, 25. And these are percentages. These are like scaling methods. All right, so that's what the double down is. What the double down means is if I have a trade, this is day trading, swing trading, anything. So I have a SPY trade. And I can spend in my price range. This is not using half of your account in your first buy and another half in the second buy. This is strictly with using if you have a $10,000 account and say you only put 5% in a day trade max. So it's a $500 trade or a $1,000 trade. Whatever predetermined amount is your max exposure level. So we're going to use $1,000 because it's super easy across the board. We can use 100,000, whatever. So in a $1,000 trade, what that means is your first buy is going to be approximately 20% of what you are total willing to spend on the trade, or 25. There's two. There's the 20, 40, 20. There's a 25, 50, 25. All right. And then there's the 15, 30, 55, where your third buy is your biggest. All right. For me particularly, I tend to use the 15, 30, 55-ish method and the 25, 50, 25. I believe KT does 20, 40, 20. So what that means is my first buy, if I'm planning on 3 buys max, and I know, especially with day trading, I know my second buy, usually 90% of the time, I'm not going to get to a third buy. All right. So when it comes to day trading, I'm not really looking to use that 15, 30, 55 because I'm usually not even going to, I'm usually not going to get to a third buy. So that one kind of goes out the window in my opinion. I'm more so doing the 25, 50, 25 or the 20, 40, 20. All right. So on a $1,000 trade, that means my first buy is going to be approximately $200. If my max wants to be $200 in the trade. All right. So that's my first buy is 200. My second buy would be 400. That's the double down. And that's where I think a lot of people get confused. Is for me, the term double down means second buy is double the first buy. Because double down is different than double up. Double up means just doubling the position. Double down means I'm putting double down than I did the first time. So you got double down and you got double up. So for me, double down is double the buy second time, and then double up is doubling the position. All right, so those are the criteria for it. All right. So a first buy would be $200 and my second buy is $400. More times than not, 95% of the time, I'm never even going to get to a third buy with day trading. Now, for day trading, all right, I got a bunch of text boxes here. You probably can't even see. I should have done this on TradingView. So for day trading for me, I'm doing 25.50. In rare case of third buy, 25%. All right, for swing trading, I'm almost exclusively for anything a couple months out or longer. If I'm buying contracts that are four weeks out or further, I'm almost exclusively, no matter what, 100% of the time, I'm doing the 15, 30, 55. Pretty much it means my first buy, I want my first, if you put it into segments, all right? And there's total segments of 10, all right? My first buy, I want to be only 1/4 of the total amount of money I have. So I want to be able to double down twice, all right? And the second one's not quite a double down. It's 55%. And I'm not going to do 14%, 28%, 60%. No. So I want to be able to double down each time. Because what does that do? What it does is it allows us to, in a trade, get back to break even much quicker. All right. So when I did double down today, I'm going to use today as an example on the SPY. All right. When we opened this morning, now we had a capitulation yesterday. We had identified earlier today that this was our fibs levels. Okay. So before the market even opened, as we were prepping for the stream this morning, we had identified this as our 25% retracement, which is pretty much the dead cat bounce area. And we had identified this as our 50% retracement. All right. And why is this so important to double down? And this is why. We are never, ever, 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 ever doubling down just to lower our cost. We are doing it at key levels only, with our stop loss just on the other side of that level. So what does that mean? If we go to my trade this morning, I'm going to show you exactly what this means, okay? And this was actually more like right here. I drew it a little different. All right. So what that means is the following, all right? And this line actually was right about here. I think I had charted it a little different this morning. So we had this line here earlier today. And as we were trading and we were waiting, we had seen that we had this falling wedge pattern, and it broke bullish. All right. And we had already tested, what's the criteria of the trade? We had already tested the 25% retrace once and slipped below it. All right. So at that point, I felt confident that if we slip below this 25% retracement again, that we should get a high volume sell-off. All right. Which we did. If we look at the volume when it actually did happen right here, it was pretty high volume sell-off we got going on. We got increasing volume. We got all the things. That's fine. That's not what this is about. So, because we're impulsive and we're human, I didn't wait for the loss of low a day. I waited for the loss of the 25% retracement. All right. So my first buy was right here. And I knew, because I knew it was an elevated risk type trade because we were just above previous low a day and we're right at that 25% retrace, I had told you guys that on this. So we had a fibs from our high a day today to our low a day. So we had identified this right here as our fibs on the sell-off today. Now remember, this is our fibs off of the capitulation from yesterday, so we're going to dot that line. This fibs was our 25% sell-off bounce from today's selling. So when we took this entry right here, I had said, because we know 25% bounces are major areas. So I automatically had said, if we happen to get a bounce here, all right, that I was going to double down at the 25% rejection, which is right here, all right? And my stop loss was going to be the break and the hold of the 25% retracement. My stop loss was right here. And what happened immediately? The very next candle, we started pushing up, all right? So at that point there, I have already bought $200 worth of contracts. We're pushing up. I have double that. I have $400 worth of contracts ready to go for that confirmation. And the reason we can do that with minimal risk in the double down is multifaceted. Because A, it's kind of a two-prong approach. We're doing it this major crux, this major level of contention, our 25% retracement right here. So I know immediately that this is going to be a decisive place, that if we break above our area of contention, I'll immediately stop out. So those double down extra contracts will be minimally red when I stop out. So it's minimal risk. But what I do with this double down is, if this is my average, we bought right here. So here's my average price. I'm not going to put a price, I'm going to put a line. So this is the average price we had right there. All right, we're going to make these blue. All right, so that's my average price. If I double down here, what happens is 2/3 of the way up, because I doubled down. All right, so I bought 2/3 of if there's 3/3 in one, I bought 2/3 of the contracts I'm in up here. So my break even goes to the 2/3 level, which is right about here. Okay, so this is my break even. I'll make that green because, as you could see, here's 2/3, and then here's 1/3. So by doubling down, all I have to do is sell off this much to get to break even total on my position, instead of having to go to all the way down here for break even on my position. All right? So it's the same thing of the risk reward. You know, having the bars, it's the same thing, but it's instead of profits, it's to get out break even, et cetera, et cetera. So if we bought here and then this is our stop loss, it's still better than a 1-to-1 risk reward. So it makes sense to do so, because what happens is it makes your probability of getting out of that trade at a good level that much higher. All right. So what's the next rule for that? So if I bought $200 here, and then 400 here, the next rule on doubling down is, once I'm at break even, I immediately sell the double down. So the second I cross and hit this line to break even on the whole trade, this is gone. I immediately sell that 400. So now what happens is, we doubled down here. This was our original position. We already doubled down. All this is done. Now, what I have accomplished is, here's my average instead of here as my average. And on top of it, we used a sound chart of the 25% rejection. So what happens here is, it's the 25% of this low a day right here. So essentially what happens is, if this is my entry, All right. I'm already highly in profits by our original entry. And then way down here is where I expect to go at that 25% retrace rejection. So our total risk reward candle works out with our risk reward, and sticking to that plan, we're still at a 2 to 1 risk reward there, or 1 to 2 risk reward there. All right. But the biggest things with that double down is immediately getting rid of the extra contracts once we're break even, and B, getting in just before at a rejection, at a VWAP rejection is great, or a VWAP bounce. Get in at those major points of contention. You don't just randomly add contracts on the way up or the way down. All right? Does that make sense so far? I don't think anyone's listening. Everybody's trading instead in this horrible chop. So that's doubling down per se. And then what had happened is, instead of, because we ended up dumping really nicely and we ended up with 65% profits, and we literally had cuts all the way to down here. We ended up with this profit instead of this profit. Because a lot of people are, why would you risk it when we're coming down anyway? Because even if we took the rejection, we start coming down, what's our ultimate goal in the trade? If this is our entry and we're way up here, and this is going to be our stop loss, we have to come all the way down to here to do what? You know? So that is doubling down. I hope that's how KT doubles down as well. I am definitely exposing that I have not watched his videos in probably a very, very long time. Going full position right away is a recipe for disaster, because if the trade gets away from us, we're going to overcommit. That's when we end up overexposed in a trade. It's crazy. Even super, super consistent traders, and I'm going to use an example of someone who's been great and really built their account back up in the last few months, and that's Idaho Justin. All right? But when he has a losing day, he's losing 15, 20% of his account. He's way too overexposed. So as much as he's doing better, there's still a definite disconnect in his risk reward at that point. And he shares openly in here, so I'm not violating his trust by saying that at all. So on swing trades, doubling down. Let's go to a swing chart. Let me think of a trade where I have added, I think snow I did. All right, so the snow trade. Let's put on the daily. There we go. All right, so this is actually a really, really great example. All right. So, snowflake here. We're on a daily chart. I'm going to delete everything off this chart. And I'm just going to use this as an example of one I believe I did double down on. All right. I'm pretty sure I took a snow entry right about here. All right. And we, of course, we could see we started selling off. But if we look at a long-term snow chart, let's look at the weekly. When I took that trade, I had a really great risk reward because I knew we had this super heavy support right here. All right, that was our support level right here. And I'm making a box because it kind of pops up to right about here. Okay. So that's a major, major level. If we lose that level, it's we have a clear, this is where we need to be out of the trade. So with snow, our entry was there on that candle. Now remember, with these trades, I will With swings, I tend to do 15% buy first, and then 30%, then 55%, or 25%, 50%, 25%. Those are the two most common and popular. For higher risk swings, it's better to use this one. But for 90% of the swings I do, I use this one. Because I have a hard stop after my double down at the loss of trend, I usually won't get third buys in. All right? That's just the reality of it. So I bought here. All right? And our target zones were, probably here. And then, of course, here. And then longer term. All right? And we instantly started selling off. All right? And we're selling and we bounce and we sell and we bounce. By right here, I feel like this actually happened too. So right here, the second time we bounce, right there. If we really zoom in, we created a lower low. Let me move this so you could see it. We created a lower low here, so we cleared out all the imbalance, and then we took a hard bounce. All right? So, at that point, I doubled down. Why? Let's say we were out 4 weeks on contracts or 6 weeks on contract. This is like 14 days in. So we're more than likely upside down, let's say 35% here. But before I took this trade, I had already decided this will be my stop loss area. And if we take a hard bounce in here, I could double down in that area. Because remember, if we go to the weekly, this is an incredibly, incredibly strong support. So our chances of feeling pretty good about that, work out. So what happens is we're down 35% right here. All right. And with the double down. So if my first buy was, let's say $1,000, I'm doing $10,000 for this trade. All right. My second buy is going to be $2,000. And I'm in $3,000 altogether. So what's different with swings is the following. At a double down, all right? And this is important. Guys, pay attention to this. This is very, very important when it comes to doubling down with swings, all right? So if we go to our OG, bell curve. Oh, that's terrible. I got to redraw it. All right. Everybody should know the bell curve. And if you don't, why is it drawing crooked? Is my mouse messed up? All right. Good enough. So we got our bell curve. All right. We've got the midline. We've got our first quadrant. We've got our final quadrant. So with doubling down on the bell curve, and for anyone that's not familiar with what this bell curve is, go watch my videos. You should be ashamed of yourself. I know I've taught it a million times. Basically, this right here is your peak profitability. All right? So if you go out 12 weeks on a contract, this would be 6 weeks. That's pretty much your peak profitability. Not that you can't make more, but this is the peak where the Greeks are working for you, where you're getting that max entry, da-da-da, so on and so forth. Like by here, we want to be trimming no matter what. So if we go back to our double down, all right? If we're in here, make that green. Oh. That means we don't have to switch our contract here. If when we hit that double down point, we're less than halfway to our contract expiration, we could keep the same contract. However, if we have reached any point into the second half of our contract, oh my God, I cannot stand when the brushes lock. So if we're in this part, our double down needs to be pushing the contract out to a new expiration. All right? Does that make sense? Is anyone listening? And have I lost you? Does that make sense, everybody? Not one person talking, so that's okay, though. All right, so here, we're 35% down, all right? But we're still, if we went out 12 weeks, 6 weeks would be the midpoint. We have not gone 6 weeks, so we wouldn't have to roll it out at all. So if this was our entry, all right, we entered here. All right, here's our entry point. Remember, I'm going to make these blue because I don't know what else color to make them. All right. So then here was our double down. The second time we bounced and we pushed and got past the major level, whatever it might be. But let's say right here we doubled down. All right. And we had already established that max pain here, max pain. All right. So our double down stop loss, our double down max pain is going to be there. Yet our main target is still way up here. All right. So this is why double downs work. So right here is our entry, which brings down our average 2/3 of the way, a little less with options because of theta. So if we were to break this into thirds, 1/3, 2/3, 3/3, doubling down here would bring us to right about here for our average. All right. That's our new average. We still have the original target up here. All right. That's our target. And then here's our stop. All right, that's the max stop. This is our max stop. Of course, it's not ideal. We're not at our original, entry targets, this and that, as far as risk reward, but we're still better than a 1-to-1. So it makes sense here. And honestly, with something like this can be like if your long-term leaps, whatever, but in a chart like this, you can also make the case for this right here being the stop loss because we had a double bounce right there. All right. So playing this tighter, you can make the case for that being your stop loss, which is going to raise this way up to here, and you're at about a 1-to-3 risk reward. All right. So again, right here, we spent $1,000 and make it $100. All right. We spent $100 here. Down here, we're minus 35%, and we add $200 worth of contracts. I already wrote that somewhere else. So here, we add 200. All right. So here we're at add 35%, add 200, and at 300 total. Now, what's different, all right, with swing trading, it's impossible to alert all this, but if you're swing trading on your own, this is how I play it. So obviously, we sell the double down here at break even. So once we hit right here, All right. Once we hit this break-even point, we're back down to 100 in contracts. But here's the hit. All right. Our original entry, when you identify the major point of confluence past our original entry, so for this, it would be the break of this line right here. And I'm going to change this from blue because that's our entry point line to just a regular trend line. All right. So here we're back down to our original position because it's very likely wherever we hit that trouble in the first place, we might get rejection. So what's great about it is the following. All right. A, we've got built-in profitability where our trade originally went haywire right here. All right. And B, if we break that area, we have now identified an area to double down on the plus side. Meaning we still like the original trade, and instead of being at break even right here, we came down, we retested, we're breaking through it again. We doubled down on the plus side here. So we're green and we're getting to take our original entry we liked all together. So on this double down on the plus side right here, where we're back to our original entry, say we're up 25% here, and at this line, say we trim, or if we get rejection, we leave it. But if when we break through it, we double down on the plus side, a positive double down. So then, by the time we hit here again, instead of being in $100 on our first buy, because we're profitable, approximately, let's say 25% right there, because we're profitable, that pays for part of the double down too. So instead, we can be in for 300 and up 10% on the trade. And we have an extra layer of confirmation because we broke through where we originally took the trade. And then obviously this thing ripped face from there. But that is swing trading doubling down. I usually am very rarely taking a third buy. So for most of the trades I alert, it's going to be this. And I hope that makes sense, guys. So that's doubling down. Doubling up is just adding to it. Of course, emotions are way less active on swings because you've got a whole plan together. When you're day trading contracts that expire tomorrow, I don't know if you can hear me, Mag, or you're just saying in the chat, but when you're day trading contracts, you got to watch go 5-10% in 1 minute. It's it's terrifying. You have no time on them. Once they turn red, the likelihood of getting out of that hole is just death. Yeah, do it. You know how many people said, I'm only going to swing trade for a while? Because this is the thing, Mag. With the swing trades and the super, and you have a green name, you better watch those. I don't know if you watch the videos on my YouTube, but you have to. If you want to be successful swing trading with me, you got to watch my playlist. At least the first 4 videos. Period. Because that's going to give you everything you need to be a successful day trader with me. But anyway, build up that money and then no one should be whipping through their whole cash account, their entire bankroll every single day of the week day trading. Period. There's a reason you see KT, even though he's been successful all year, it's always like $2,000 he's in the trade, even though he's been making money all year. For me, it's always like 10 contracts. Stop. It's like 10 contracts. I could buy 1,000. Am I? Fuck no. You expose and I talked about that at the beginning of the streams, and I'm using Idaho Justin as the example. Yesterday, he lost like 15% of his account on one trade. All right? In order for you to lose that much on your account in one trade, you are exposing way too much of your account on a single trade during FOMC. Horrible. Horrible. Like, you guys see my profits. In this account, I've pulled $250K out over the year, and I've got 525 peak right now. So that's about 700,000. All right? And I'm putting 2,000-3,000 max in a day trade out of 700,000. And that's not a flex. All right? If you can't afford the trade and you're going to be in more than 10%, don't fucking take the trade. Period. NVIDIA contracts are cheap. Apple contracts are super cheap. Palantir contracts are cheap. SPYs are cheap. If you have a hardcore risk reward, all right? We're on SPY, like right here. All right? You've got it, and like we did earlier. You can go out of the money a little further. You can. Because you trust your process. Because, yes, it's a little more risk. The contracts get data burnt a little quicker because they're out of the money. Or, I should say Delta. But you're exposed to less risk. If you have a $1,000 account, guys. All right, let's look at this. Say you have a $2,000 account. All right? But you're great at, like, this is my stop loss level. You don't have that issue of, I cut every win at 20%. I cut every loss at 50%. Like, you have you're pretty hardcore and stringent with your rules. You can go a little further out of the money. And I personally, and this is not a popular opinion with Mr. KT, so mute your earbuds, KT. I personally think it's better to risk less money, because here's the thing. None of you assholes are holding this to in the money. You ain't holding this for 300%. You're taking your 30, 40, 50, 60%. You're not holding this all day deep into the money. But if you have shit risk reward and shit impulse control, no, you can't go a little further out of the money. Period. But in general, exposing $50, all right, right here. Say you have a $1,000 account and you buy two of these $50 trades right here. Say you have a $2,000 account. You buy two of these 50s so you have money for your double down if needed. And this goes sideways. And you sell for a 25% loss. You lost $12. Maybe up at these 591s right here, instead of a 25% loss, it might only be a 20% loss. But because of the way the delta works, it was slightly less red. But even with that 20%, you're losing more with only 20%. So on this $1.15 contract right here, even here, if you're going right to the money, $1.60, and you lose 20%, this contract right here, you lost $30 on. This contract, you lost $11 on. So for small accounts with proper risk reward, going a couple contracts out of the money isn't terrible. It's not a terrible idea. Because our primary purpose in this Discord, if I know all you guys, none of you motherfuckers are holding a day trade all day, waiting for it to get in the money. Bullshit. 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 Y'all are out of this trade in like 18 minutes. So what the fuck does it matter where it's at? And sorry, KT. And this is kind of for small accounts only type thing. And risk exposure only. Because you're the type that's going to blow up your fucking trade. You're going to blow up your fucking trade either way. But at least with this, so say you hold shit to 50% down every time. All right? If this one's 50% down at 591, it's $1.52, you lost $75. Go down to this one. Maybe this one lost 70%. 70% instead of 50% because it's further out of the money. You still only lost $35 instead of $75. So I don't give a fuck about that 20% because either way, it's still cheaper. You still lost less. Even at 70% down. Even if you blow it up and hold it to zero on a $50 contract, and this is still worth 33%, you lost $100 here and $50 here. So that getting closest to the money as possible, it's great overall, absolutely, and it's safer, but you're losing more dollars if you're overexposing yourself and constantly churning and burning your entire account every day of the week. So take it for what you will. I know that's like the antithesis of a lot of shit, but it's something I have to just be honest about, you know? But anyway, so like a trade like this, you know, say you bought puts. All right, so let's just test this theory, all right? Say we bought puts, expected ourselves to reject right at this dotted line. So say we bought puts right here. All right. So let's say we bought it right here, right at the tip top of this candle. So what time is this candle? 10:21. Say we bought puts at the peak of the 10:21 candle. Let's check. All right, right here. So here's the closest in the money. 10:21 candle peak. We were at $2.42 a contract, and we're at $128 now. All right, so let's do the math. 242 minus 128 is 14, so $1.14. AKA, all right, let me divide this. 128 divided by 242. AKA 52% down. All right. We lost $1.14 or 52%. We lost $1.14 or 52%. All right, so let's go further out of the money. Let's do these 32. These were probably around 50 when it started. So let's do these 585s. All right, let's check those. The 21 candle. Peak price high was 64 cents. So it went from 64 to 29. Hold on, let me go to that. So it went from 64 to 29. I want to be on the same screen. So the other one went from 0.64 to 0.29. So down 35 cents, aka 35 divided by 64. 54%. All right. So it's within 2%, the percent down, the one closest in the money to 5 strikes out of the money. But this one, you lost $1.28. This one, you lost 35 cents. Right? Right? So, for small account purposes, being super cognizant. Hold on, guys. I gotta take a drink of my pop. I'm on one today. I got dry throat. So just remember that. And now a couple things about this theory. In general, we'll go further out of the money. A, it works on like high volume contracts. Palantir is another good one. This and that. High volume churn contracts. All right. Because for me, starting out, if I have a $1,000 account, a $3,000 account, I'm okay with spending $50 a contract with a 35% stop loss on that 50 versus $150 a contract with a 28% stop loss on it. Because most of you, if you're holding to 50, 60, 70% down, you're fucked anyway and you're not going to last. And B, the whole trying to get it in the money, no one's holding that shit into the money. Now on swing trades, much, much different. Going too far out of money will destroy you on swing trades. All right? For small accounts also, if you buy short-term contracts that are far out of the money, it's 100% necessary to sell into the momentum. Any large pullback, you will need a bigger... Absolutely, E-Trades. And that is absolutely the case. And that's where I rotate back into this consensus overall pretty much for what I've observed in this group. 90% of the small accounts in here are selling into that momentum. Because y'all a bunch of paper-handed little wussies sometimes. You know? Until you go red and you're holding the 50% down. Just saying. So that whole likelihood of them holding it for too long on the plus side, rare. Alright? Finally, being super, super cognizant of what time of the day it is. Even close to the money. All right? If we're in the last hour of the day, all right, everything gets wrecked, even one strike out of the money. That's why it moves so damn insane to the plus side. When KT catches a bid and we get a move like this, all right, now, let's see what it was right now. All right, this move in our out of the money contract 78s, which is one we would like to take. This move was 35 cents to 68 cents, almost 100%. This move, KT, what would this move be the last 20 minutes of the day? 300, 400% on a contract 4 strikes out of money? Like a 40-cent contract, this move, the last hour to half hour of the day is going to give you 300% plus. All right? I don't know if he's listening anymore. He's probably firing me for talking about going out of the money. Yeah, he ain't listening. I see how it is, KT. Okay. He left. Oh, he got mad. I told him to cover his ears. He left the chat. You guys go blow up the chat and say, don't fire Amy for talking about out of the money contracts, please. Go fight for my job, guys. He even left the chat. He's very mad at me. All right. Anyway, just some things to consider, you know, because I see some of the fumbles I see members taking are so damn avoidable. It's insane. All right. What did E-Trade say? When I'm out of the money, it's 75% on first pop, 20% second. I love it. That's pretty much where I'm at. There he is. He's hiding from me. Jump in the chat. Can he jump in? I want to ask him. Is he in here yet? Come on, KT. Oh, he's in here. Okay, KT, here's my question. All right. So this move right here, like 3 or 4 out of the money, the cheapy contracts, kind of like you buy Power Hour. So from the bottom to the top was about a 95% move. And I was telling them the last hour of the day, what kind of move would this be? Like at least probably 300%. A move like this with a contract that costs like 30, 40 cents. That's me a multiple 100% move, correct? You're the Power Hour king. Like it's like 3x the move once you get into Power Hour. So that's where being out of the money, you got to be even more cognizant. Anything out of the money, whether it's one strike out of the money or 10. That was my question. Look at that rip. Right off the 25% retrace. What's up, Katie? Beautiful. Oh, do you? Okay. Uh-huh. That makes sense. That makes sense. Because at Power Hour, the contract 1 out of the money is the same price as a contract 4 out of the money at this time of day. Okay. Mm. Gotcha, gotcha. Yep. Understood. Understood. That was a beautiful bounce. But that makes sense. So basically, in conjunction to what I was saying, guys, these 50 centers that we were talking about right here that are 2 out of the money, by the time Power Hour hits, that's going to be the ones closest to the money. So yeah. Yes. So I have a question. If it Exactly. So I have a question. When it's Power Hour or getting close sometime in the afternoon and you're red, say you're red 30-40% on a trade, but it's at a major bounce point where you would double down, are you going to rotate to closer in the money? Are you doubling down on the contract you already had? Okay. Yeah. Yes. Yes. Exactly. Like, yep. Like if you have an 18-cent SPY contract that you bought originally at like 40 cents, there's no way in hell, the what it's going to take for that one to bounce back. So many people will just average down in something that's shit at that point, and you're better off just keep those where they're at and then buy a closer strike, and then add them together for your overall P&L. Yes, absolutely. Yep. Yep. Exactly.